There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarley. This Thursday afternoon, we are awaiting Wesfarmers CEO Rob Scott to join us after, of course, a more than 14% increase in full-year profit. But let's just have a look at where the local market is finishing out the day's session. A pretty solid gain by the end of the day, up 0.25%. The ASX 200 is only 25 points away from 9,000. Quite extraordinary when you think about all the earnings that we have delved through over the past month. What a month August has been. Of course, still one more day, but up by something like 3% over the past month. Jason McIntosh from Motion Trader was telling Andrew earlier on the trade that it's one of the best Augusts that we've had. And of course, while some companies have been punished this reporting season, a lot of others have done incredibly well. Let's talk though about the overall thematics of today's trade, and certainly it has been a sense of, are we there yet? We do have one more day of reporting season to get through. A lot of earnings out today, including IDP Education, worth noting that is up by some 28%. Eagers Automotive is up by about 12%. Qantas soaring, yes, pun intended, to record highs after its results, up by some impressive 10%. And of course, we'll discuss Wesfarmers in detail with Rob Scott momentarily. There have been some stocks that have been hit hard though today, and those include the likes of Telix, down some 18%. And of course, Tech check. It was all about Nvidia overnight. US markets did rise in anticipation of, as Wedbush's Dan Ives tells us, the godfather of AI. Look, of course, there's nothing wrong with the result, but Nvidia always has to really pull it out of the park or knock it out of the park in order for investors to buy into the company. And its outlook for the next quarter did disappoint, and that's weighed on a lot of our tech players today. And of course, the Fed's next test as well. We've got core PCA deflator in focus, but the US economic growth, or GDP, and jobless claims all coming through for investors to have a look at tonight. All right, Wesfarmers has posted a 14.4% rise in full-year profit to $2.9 billion and will reward investors with a surprise special dividend. Total payout sitting at $1.7 billion. Now, excluding significant items, profit rose 3.8%. Wesfarmers CEO Rob Scott says Bunnings and Kmart performed well thanks to low prices and market-leading offers. Wesfarmers also says that higher costs were mitigated by productivity initiatives, including investments to digitise operations and the increased use of AI. A fully franked final dividend of $1.11 per share has been declared. Total full-year dividends at $2.06, up 4%, and shareholders will also receive a special distribution of $1.50 per share, well above expectations. Let's get it all, though, from the mouth of the MD and CEO of Wesfarmers, Rob Scott, who joins me now. Great to see you, as always, Rob. I mean, great result. What cost of living crisis here?
Well, look, I think it was a really strong result. And what I think was pleasing about the result is that we were able to deliver this good outcome for shareholders, whilst also delivering fantastic value to households of Australia when they needed it the most. And that is what is so fantastic about businesses such as Bunnings and Kmart and Officeworks, is that the better value we deliver, the more we can drive our sales, the more efficiency and productivity we can deliver, the more we're able to lower our prices to deliver even better value to customers. And it's that virtuous circle that I think delivers really good sustainable growth in returns and outcomes for all our stakeholders.
And of course, we mentioned that you have announced that special dividend as well. Is this the result of the sale of Qantas, or talk us through that?
That's right. There's a number of factors that has enabled this special dividend. The sale of Qantas released some capital for us. There were also other smaller sales that we made, such as the sale of our LNG, LPG distribution businesses last year for $80 million. You might recall a few years ago, we sold the remaining 4.9% stake in coal. So this creates an opportunity to provide a capital return subject to the tax office approval. We also were able to distribute some of our surplus franking credits. And if you look at our balance sheet after the sale of Qantas, we have a very, very low level of debt, very low for a business of our size. So this was a very prudent decision to make for the benefit of shareholders, to give them that capital return, give them that special dividend, and it enabled us to right-size our balance sheet with a little bit more debt.
Does that mean that you have enough then to start looking for further acquisitions? Is anything on your radar?
Well, we see the opportunities for capital returns and dividends as quite a distinct opportunity from investing in new businesses. As I said, we arguably had a very lazy balance sheet because our businesses had been quite cash generative. So this was an opportunity to make a tax effective distribution. But we still have enormous capacity. Our credit rating metrics are still very strong. We would have the ability to do bigger acquisitions if we decided to. But at the end of the day, the decision on whether or not we make an acquisition is more a function of, do we think it will deliver good returns to our shareholders? And I think that discipline around capital allocation, it's really important to have that discipline, whether you have a lazy balance sheet or a highly geared balance sheet. It's quite an important thing to stay disciplined around.
Now, I mentioned, and tongue-in-cheek, the cost of living crisis, but it has affected a lot of people. Are you starting to see consumer trends pick up, particularly with the interest rate cuts and further planned? I mean, I note that the Anko brand of Kmart has been a strong driver for you, so people are still looking for lower price goods.
You're right that customers are still looking for value, and value is one of those enduring trends in the retail sector. It's always important, it's always relevant. We did call out in our full year results that we had seen a modest improvement in consumer sentiment and consumer spending in the last couple of months. And that's a result of moderating inflation combined with the recent interest rate cuts that we've seen. And that is translating to slightly better sales growth within Bunnings on the consumer side of our business. And we've seen a continuation of the strong sales within Kmart. And as we called out today as well, we've actually seen some better sales growth on some of the higher value lines within the Anko range. So that shows that customers are prepared to spend a little bit more money than they were 12 months ago.
Discussing Anko though, or talking of Anko, I mean, you're expanding into the Philippines here too. Tell us about that.
Well, in recent years, we've noticed that the Anko product is quite unique on a global scale. We have fantastic product development capabilities. We're able to achieve very good price points, and we also source our products in a very sustainable way. So we've undertaken a number of strategies to really leverage this product development expertise internationally through wholesale distribution agreements with groups like Walmart, in Canada, for example, with private label agreements where we're selling wooden toys to Mattel, the international toy company. And as you mentioned, more recently, we've trialled a few Anko-specific stores in Manila in partnership with a Philippines group called Ayala Group. It's early days. We've only opened a handful of stores, but they're performing really well. And later this year, we'll reflect on whether we accelerate the expansion of those stores.
On the other side, Rob, though, lower global commodity prices hurting one of your businesses units. Tell us about that.
Yeah, so within our chemicals, energy and fertilisers division, we had very strong operational performance, but slightly lower earnings as a result of commodity prices. So we saw lower prices for ammonia, lower prices for Saudi CP, which is a key metric for LPG. And one of our input costs, which is natural gas, we saw the cost go up in Western Australia. But what is also relevant is our new lithium business. So we're still in the commissioning phase of our refinery. So we still have a fair bit of work to ramp that refinery up. lithium prices have been quite depressed. It's been good to see a bit of a recovery in prices in recent months, and there does look on a medium-term basis that there hopefully will be a bit more of a price recovery given some of the constraints around supply. So, that is a division that is more subject to commodity price changes, but we feel we have a lot of opportunity to deliver a really low-cost, high-quality product, and we're excited about the opportunities ahead.
All right, so that's in Kwinana, betting then on that recovery of lithium. Let's talk about where you are trying to keep costs down and I guess what you're doing in the AI space too.
Yeah, so we see, technology more generally as a very powerful way of driving efficiency, productivity, and we use it in many ways, and generative AI is just a way of accelerating some of the progress in some areas. So to give you more practical examples, we have amazing data across our group. This is not just customer data, but also a lot of supply chain product data that we utilize to make better inventory decisions, better supply chain and sourcing decisions. So that reduces our costs and ensures that we have the right product in the right place at the right time. Supply chain efficiency is absolutely critical for us. So automation is a key way of driving greater efficiency. Two really interesting examples on the generative AI side is Bunnings are starting to use generative AI to support their team members in accessing a lot of technical product information across the 50,000 products that we sell in a Bunnings warehouse. So through a voice-activated chatbot, our teams are able to access that vast library of technical information to better service their customers and better inform their customers. So that's a real productivity enhancing initiative that will benefit our teams and benefit our customers.
You have highlighted in your statement to the ASX that cost of doing business pressures are persisting and geopolitical risks also present uncertainties. How optimistic, I guess, are you of the overall global economic picture over the next 12 months?
Well, there's certainly a lot of uncertainty and volatility internationally around areas such as trade in particular. Now, whilst I think that Australia and certainly our businesses within Australia are not directly impacted by some of the Trump tariff implications, if there are any changes to global supply chains, then that will have impacts on Australia. And we saw that through COVID when we saw dramatic changes in demand and supply. It led to some product shortages. It led to increased freight costs and container shipping costs. So we're really mindful that volatility can create complexity, even if it's not directly related to Australia. So we're mindful of that. But overall, I think that Australia is reasonably well positioned. What probably matters most in the very dynamic market that we operate in is ensuring that our business settings remain competitive in Australia, so that Australian businesses remain competitive, so that they continue to invest, and that is what is going to be really important for the prosperity of Australia.
Well, speaking of your Australian businesses, Rob, if we can drill down to what's happening in Victoria, because you have mentioned crime and taxes weighing on your Victorian operations. Just tell us how worrying that is.
Well, look, I think retail crime is a broader issue at a national level, but myself and other leaders of retail businesses around the country have called out Victoria as being a certain problem area, and we've certainly seen a higher incidence of retail crime and customer threatening situations in Victoria. Now, there are various reasons for that. Clearly, the Victorian economy is doing it a bit tougher, and often you do see a direct correlation between more challenging economic conditions and crime. There are also some differences in the regulatory settings and the legislation. I think I should note that I think the police in Victoria do a phenomenal job. They have a very difficult job to do. But there are some changes in terms of legislation in Victoria to align with other states that would introduce tougher penalties for retail crime and also provide greater resourcing and focus on some of the organised crime elements that impact retailers. So this is a worry for me at a personal level. I worry about the safety of our team, the safety of our customers, and this is an issue of national significance that we really should be facing into.
Absolutely. All right, you've also got a change with your chair retiring. Tell us what's occurring at the C-suite level.
Well, I think the announcement today is another great example of the very carefully planned succession planning that goes on within Wesfarmers. And our board announced that Mike Chaney will retire at the AGM next year in 2026, and that he'll be succeeded by Ken McKenzie. Now, Ken is someone with a fantastic reputation, very experienced as both a chair and an executive. Ken has a fantastic track record around delivering shareholder returns and is well known for his disciplined approach to capital allocation. So very big shoes to fill, replacing Mike Chaney. But I think Ken is an ideal choice for chair. And I'm really looking forward to working with him when he joins the board in advance of becoming chair next year.
And just a final word, Rob, on your share price. I know you're a CEO, you can't control the market. You've done very well though, but when I look at broker calls, they're sort of more suggesting that the share price value would be around $84. Any comment to that?
Well, what we're most focused on is improving shareholder returns over the long term. And that we do that by ensuring that we're continuing to grow our earnings and our returns. I believe that we've finished this year with our businesses in better shape, with more growth opportunities than we've ever had. Now, our share price will increase and decrease day to day, but what matters most is the long term. Our long-term returns have been pretty strong. I feel the group's really well positioned for the future. So if we can just keep delivering on our strategy, then I have every confidence that a shareholder buying a share today should be well rewarded in the future if we can deliver on our strategies.
All right, Rob, really always appreciate you taking time to talk to AusBiz. Thank you so much. Rob Scott, MD and CEO of Wesfarmers there. All right, so let's have a look. We were discussing what was occurring on the market and close to, 9,000 points on the ASX 200. But really, these Nvidia woes did weigh on the overall tech space today. WiseTech Global down 2.5%. Next DC, they're out with their numbers tomorrow. We're going to be speaking to Craig Scroggie, about 11:50 a.m. So tune in for that. Sydney time, down 1/3%. Energy stocks as well, really dragged down, I guess, by the fact that Woodside is ex-dividend. Take that out and not looking too bad. Karoon and Beach, I think, also ex-div today. Consumer discretionary, Wesfarmers there just finishing slightly higher. I mentioned UBS in particular is neutral on that stock, $84 price target. JB Hi-Fi and Harvey Norman are lower, along with Myer, while Lovisa, which reported yesterday, up 2%. And the banks all looking pretty healthy. CBA up 2% to $172.86. When it came to the overall corporate stories, we've touched on Wesfarmers, Qantas as well, posting full-year underlying profit up 15%, close to 2023's record, and shares hitting an intraday record and closing up 9% to $12.09. Medibank Private, we spoke to the CEO. You can find that on the website. They did post a near 2% rise in full-year profit. Shares down 2%. South 32 down 6.5% after it did actually post a pretty good result in terms of high commodity prices, but of course the outlook disappointing investors. And MinRes down 2.3% after reporting a loss of around $900 million. Quite a few other results out today, including Sandfire Resources, IGO swung to an annual loss. We had IDP Education as well. Eagers Automotive, they're up by 12%, and Telix Pharmaceuticals down about 19%, a one-year low, and that's on those FDA hurdles for its kidney cancer drug. The stock of the day, though, was Nvidia in a US special, and Mark Moreland from Value 3, Mark Gardner from MPC Markets, too many marks in that, joined Koshi on the call.
It was a fabulous result. Yeah. The thing is, the market's become a bit unrealistic because they expect them to keep increasing how far they shoot the lights out and how much they overperform what they've given guidance for, or what the market thinks, which is a bit ridiculous. But the bottom line, if you look at it, because
it was bang on forecast, wasn't it?
Well, it was slightly above still. Yeah. And it's got like the 56% year-on-year data center revenue growth. 98% revenue growth in network revenue. That's a big one actually, because that's 7.3 billion now. Yeah. Now people don't realise how big a deal this is. This is Nvidia providing all the interconnect within the AI factories to be able to make all the machines work as one.
I'm very concerned about seasonal weakness, and obviously this is a huge weighting in the indexes, and it doesn't really matter on the upside or the downside, as we've seen with CBA on the upside. If a certain amount of capital has got to fit through a very tiny door, you get overextensions, and the broader market's throwing up a load of general red flags on valuation. September's the worst month for the S&P. Traditionally, it's the only month that's negative more than half the time.
All right, a positive end to the day's trade. Let's kick it off with some of those leaders, including IDP Education. Remember, one of the most heavily shorted stocks, and its result was poor due to what we've seen in terms of the student caps, but it was better than what people were expecting. So shares up 30%. Eagers Automotive, we touched on there as well, the market liking its result, and Tabcorp up 12%. Telix, Ramsay Health lower, along with Nine Entertainment, which reported yesterday, Macquarie Tech and Bank of Queensland. In the small end of town, 360 Capital had a good session, up by 21.5%, while the laggards in the small end of town included Core Lithium, down by 10.2%. Interesting that Rob Scott from Wesfarmers talking about their expansion into that lithium space. All right, tonight, US GDP for the June quarter, 3.1% growth expected. Pending home sales could lift by 0.2% for July. And we have earnings including Dell and also Dollar General. Tomorrow, private sector credit, 0.6% growth expected. And only a few earnings left on the final day, but they include Steadfast and PEXA. Also, I believe Austal will be talking to them, and NextDC will be talking to them as well. And of course, tomorrow, don't forget the last call from 3:30 p.m. Eastern. But the market has finished higher by 0.2% there on the CBO 200. The ASX 200 has finished the session higher at 8,980. Wow, only 20 points away from 9,000. Wouldn't that be a nice finish to August? We will do it all again from 9:45 a.m. Eastern. We'll see you tomorrow.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.